The Superinvestors of Graham and Doddsville, a publication by Warren Buffett, an analysis of value investing in individuals who embrace this investing style. Benjamin Graham and David Dodd wrote Security Analysis, a publication that defined value investing. They concluded that contrary to Wall Street tactics, there was a better way to invest. By focusing on higher quality stocks at lower market valuation, they were able to realize large, consistent returns. Graham mentored one of today's greatest value investors, Warren Buffett. Warren Buffett promoted a style of value investing but focused on high-quality stocks regardless of value. He published an honorary work that discussed value investing and investors that embrace this investing style. Then and now, Wall Street investors have a hard time beating the market. Those that do are considered lucky. Buffett went on to rebuke this statement, saying that value investors are able to consistently beat the market because of this investing style and not luck. The superinvestor, as Buffett refers to, is the investor that can consistently beat the market. He references that these individuals are of the same intellectual origin as Graham and Dodd, since they all believe in value investing. Buffett's three conclusions are that 1. Margin of safety. These investors all invest with a margin of safety, i.e., that market price is below book value. 2. The size of the fund is important. The larger the fund, the more difficult it is to find large quantities of value investments. And 3. The acceptance of value investing. Investors either completely accept the idea of value investing or they completely reject it. In another publication by Tweedy Brown, titled What Has Worked in Investing, 6 characteristics were compiled to identify a value stock. These are low price in relation to asset value, low price in relation to earnings, a significant pattern of purchases by inside officers and directors, a significant decline in stock price, small market capitalization, and high dividend yield. Graham had much more extensive criteria, but this gives a general view of value investing characteristics. Jean-Marie Eviard writes about the differences between Graham and Dodd and Warren Buffett. As you can see, Buffett is interested in high value and high quality stocks, where Graham and Dodd appreciate low valuation regardless of quality. The following group of investors comprised of both the investors Buffett specifically mentioned and those that can be referred to as value investors in today's markets. Each profile gives a short biography, investing style, sector weighting, return history, and top 5 holdings. It is important to recognize the returns comparable to the market return. The following 8 profiles are highlighted for specific return statistics, and 2 new profiles are added to show current value investors in the market today. On the left is a chart of returns for the Superinvestor Index, also known as the SI Index, versus the S&P 500 and showing the excess return. Notice that there are cases of negative returns in the SI Index, but note the frequency and extent of those losses compared to market. On the right is a list of past and current superinvestors. The following 8 profiles are the 8 superinvestors chosen to calculate a more extensive analysis. Each individual and his respective fund have different holdings and sector weightings. One thing in common is their investing style. I will go ahead and focus on these common traits. If you would like to look more closely at each profile, feel free to pause the slideshow at any time. Warren Buffett, who manages a fund at Berkshire Hathaway, has this philosophy: that successful investors must learn all they can about the business they are buying and stick to industries they know. But the right temperament is also important. You just have to avoid getting excited when other people are excited. Ian Cumming, who manages a fund at Leucadia National Corporation, buys distressed companies at discount prices, revives them, and sells them for profits. Buys assets that are out of favor and therefore cheap or disheveled. Their strategy is that they don't overpay. They buy companies that make products or provide services that people need or want. Sheltered earnings are more valuable than taxed earnings, and once again, don't overpay. Mason Hawkins, who manages a fund at Southeastern Asset Management, has this philosophy. When evaluating potential investments, he looks for 3 things: good business, good people, and a good price. Typically, Hawkins invests in companies trading at 60% or less of intrinsic value, appraised by looking at the current value of the company's assets and liabilities and also by looking at the present value of future cash flows. Mario Gabelli, who manages a fund at Gamco Investors, employs a research-driven and value-oriented approach to investment analysis. He developed a metric of his own known as private market value, PMV. This valuation metric places greater emphasis on analyzing a company's cash flows and gives less importance to accounting profits. Dave Tepper, who manages a fund at Appaloosa Management, takes an interesting spin on value investing. He buys distressed companies with high amounts of revenue under the assumption that they will be bought out or bailed out. Stephen Romick, who manages the FPA Crescent Fund, seeks value in all parts of the company's capital structure, including common and preferred stocks, as well as corporate and convertible bonds. He invests in securities that the consensus does not wish to own. searching for stocks and convertible bonds that reflect low PE ratios and trade at discounts to private market value. Corporate bonds with yields substantially higher than those of government securities are also considered. Daniel Loeb, who manages a fund at Third Point, LLC, pursues a research-driven strategy based on fundamental value. The primary focus of the investment effort is to identify event-driven situations in which a potential event should lead to a significant revaluation, up or down, in a company's securities. Daniel Loeb has the capital to assume large positions in companies and influence the affairs of those companies. Ron Barron, who manages a fund at Barron Capital Management, invests primarily in small and mid-sized growth companies. He likes companies with open-ended growth opportunities and defensible niches. He applies a bottom-up company research, invests for the long term, and tries to purchase companies at what he believes are attractive prices. These 8 investors yielded returns shown on the left. Notice the astronomically high returns from these investors. No amount of luck can yield these kind of results for a 15-year period. Something must be inherent in their investing style. These are the 10-year rolling returns from 1998 to 2012. Notice the consistency at which the SI index outperforms the S&P 500. The average annual returns of the SI index versus the S&P 500 and the Russell 2000 show an unimpressive graph. However, when looked at closer, you can see that the SI index beats both the S&P and the Russell almost every year. The only significant negative return was during the 2008 economic collapse. However, in 2009, the SI index returned over 49%. Cumulative returns show the absolute dominance of the SI index. Note the 2008 economic collapse and the 2002 dot-com crash. What is truly remarkable, and what qualifies their title as superinvestors, is their ability to outperform the market and recover and limit losses during economic downturns. The following 2 slides are examples of current value investors that I have selected to be considered superinvestors. Duilio Ramayo manages the Rebecca Boston Partners All-Cap Value Fund. He examines various factors in determining the value characteristics of stocks, including price-to-book value ratios and price-to-earnings ratios. These value characteristics are examined in the context of the issuer's operating and financial fundamentals, such as return on equity and earnings growth and cash flow. Rebecca selects securities for the fund based on a continuous study of trends in industries and companies, earnings power and growth, and other investment criteria. David Einhorn manages a fund at Greenlight Capital. He believes an investment approach emphasizing intrinsic value will achieve consistent absolute investment returns and safeguard capital regardless of market conditions. He is a noted activist investor, taking positions in companies, then pushing management to implement changes. Evident from the performance of the SI index, we can conclude that these super investors historically beat the market. The question is, are these returns able to endure into the future? From the evidence after 2008, it looks like the answer is yes. I believe that information is more readily available than ever before, and governing bodies are regulating the markets more closely. Thus, markets are becoming more and more efficient, and obvious value investments are harder to find. However, even with the progression in market efficiency, I believe that valuing companies is a financial art backed by financial science, and the subjectivity of this art continues to empower the value investor.